Right. Hello, everybody. Steve Griffiths here, developer of the MT Predictor software program. Could you just all let me know whether you can hear me okay and whether you can see the slide there okay, while I just remind you that all examples in this training room should be considered as hypothetical. No trades are actually taken. They're just shown for illustration and training purposes only. Remind you there's a risk of loss in trading and investing. Put another way, all professional traders know and understand that losing trades can and will and do unfold. It doesn't matter what trading approach you take, there always will be losing trades. And we'll have a look at some losing trades in today's webinar as well. Right, so welcome to everybody. And let's start off by looking at the ES. We'll be looking at some Forex charts a bit later in the webinar as well. So today's webinar, I'd like to focus again on a topic I was looking at a couple of weeks ago about trying to, in fact, I've looked at quite a few times over the last few weeks, trying to increase your profits by letting your winners run. Because there's three parts to becoming a successful trader. The first part is to trade less. In other words, have the patience and discipline to only trade when you get an ideal setup. The second part is when you get losing trades, and you always will, no matter what trading approach you take, that always will be losing trades. I mean, this is not a valid one against the blue MTP trend, but just want to remind you that losses can and will and do occur. But the trick is when the losses come through to keep the losses small. So that's the second point. The third point is to try and increase your winners. And this is, I think, the last part that most people find hard is trying to let your winners run. So that's what I want to mainly be focusing on today. So let's just quickly review about what MT Predictor is about, how we actually look to find our trade setups. This is our standalone version. By the way, for you guys who've got our standalone version, we released a new version, build 8.5.0.3 this morning. It's available for download within the members section of the website. So you can go in there and download this, the latest version. But we also have add-ons for NinjaTrader 8 and also scripts for TradingView. If I just pull, I've got TradingView here. If I just pull TradingView into the webinar, you can see here's our scripts for TradingView. Right. So how do we approach trading? Well, you can see we have automatic setups on our charts. So is it a case of just blindly following these setups? Well, the answer is no. The answer is no, because half the time, or maybe slightly more than that, markets are random. In other words, they're not doing any clear or discernible pattern, and you can't really do any kind of analysis. Now, I think this is something that a lot of people actually sort of struggle with, is that trying to understand that you should only really be trading when the picture's clear. So how do we do this? Well, if we want to look at a 3-minute chart, I want to go back and look at yesterday. This is a 24-hour chart of the ES I'm going to use here. So I want to look at yesterday during the New York Open, and in particular, this VS buy setup here that caught the low really nicely. So what do we try and do? Well, what we try and do is we try to go to the higher time frame chart. So a higher time frame chart is between 3 and 5 time frames higher. So in other words, if you're on a 3-minute chart, you'd be looking at a 15-minute. We'll be looking at some 15 and hourly Forex charts a bit later, or if you're on a daily chart, you'll be then looking to the weekly. So it's a time frame between 3 and 5 time frames higher. I'm just going to use our training mode and jump back to this point here. So what we do is we place our DPs on the chart. Now our DPs are our decision points. They're leading indicators. They're on the chart there in advance. We don't use any old pivot to place the DPs on. We use specific pivots, and there are a couple of webinars that are recording in the customer section of the website that you can go and review this in a lot more detail. But for those of you who have been using MT Predictor for a while will know that as a market is starting to retrace back, we use the last swing into the high or low. So the market here is retracing back. This is the last swing into this high. You can see obviously this is a high. This is the last swing into the high. We'd right mouse click off this low. We do decision point. Oops, missed it. Oh, my mouse Wasn't quite right there. But as you can see, this gives an area of support because the market's starting to go down. But the most important point is that this support is on the chart in advance. That's the whole thing about MT Predictor. What we're trying to do is we're trying to look for areas in advance. We're not looking for scanners or market analyzers or alerts. In other words, where you have to react to something once it started beeping at you. What you need to do is work in advance. Be prepared. Get ready. So this is on the chart in advance. Let's see what the market did. It started to climb down, and then suddenly it just clipped the low there. This is when, I'll just turn trading mode off. This is when we go to the time frame we're looking to trade off, and then we see what happened there. And as you can see here, this VS setup just tagged this 15-minute DP. Our MTP trend was an agreement, being grey or blue, because we're looking for buy setups. But the point being is that we were looking for a reversal that's happening at higher time frame support. In other words, two different time frames coming together. If the market then gets to a level, we're not saying it's going to, but if it does, we then look for a reversal. If it does reverse at that level, we then deem that the market picture is then clear. In other words, we have a clear higher time frame picture, and therefore we look to take trades in that new trend direction. So if we're looking to if it's looking to reverse that higher time frame support, we'll be looking for buy setups. As the market reverses off that and starts to go up, we'd then also be looking for buy setups, and that's why we'd be avoiding any potential sell setups, as you can see by these history triangles here. This is also helped by our MTP trend color. But notice how we look at our DPs first and not our MTP trend color first. This just helps, confirm it. So that's the whole idea behind MT Predictor, is we're looking to only trade when the market is making a clear picture of a reversal of a higher time frame support and resistance zones. And that won't happen all the time. I mean, sometimes it works absolutely beautifully, because if I look at a bit earlier in the day, whoops, sorry, going the wrong way there, a bit earlier in the day yesterday, the market was going up here, but look where it went up to. If I go back to this last major pivot high here, again, this was the last swing into that low. Do you see that? There's the low. There's the last swing into that low. So you'd have put a DP off that high. This would have given you an area of resistance as the market was going up. But look where it made the high, made the reversal there beautifully before the market started to go down. So it caught that high beautifully. It caught that low beautifully. Does it always work? Of course it doesn't. If it did, we'll all be billionaires overnight. But, you have to then work with when the market is making reversals at these levels, because this would then be the last swing to the low. Therefore, with right mouse click off this pivot, you can see this would have been our next resistance area. And as you see, the market just blew straight through it. So in other words, it didn't make a reversal at that level. So the DPs won't work all the time. Nothing works all the time in the markets, but they do work a significant amount of the time. So this is when you come down to the shorter time frame charts and you see what the market is doing in these shorter term at these sort of higher time frame resistance zones. You can see here we got a shorter term signal at the higher time frame support. This one here that didn't work, we didn't. There weren't any setups there. Therefore, you wouldn't have been taking a trade, so it didn't matter. It didn't work. This one here, there was a reversal at that higher time frame resistance area, but we didn't get a setup there. But what it did is it changed the large trend to down. So as the market was coming down, you'd be then avoiding these buy setups, which obviously didn't go as well as we'd have liked. So that's the basics behind MT Predictor, and it's important to grasp this idea. And this helps you with the first aspect of our trading, which I was talking about at the start. In other words, point number one, you should only trade when the picture's clear. In other words, you shouldn't be trading all the time. We're looking for you to trade far less than you probably would like to. Yeah, you're dead right, Timo. If MT Predictor worked all the time, 100%, if anything worked 100% of the time, the market wouldn't exist. But then it's because lots of people have different views on where things are going to go, that then creates the market, doesn't it? But, we do have a huge advantage with MT Predictor, because as you can see here, we do have reversals off these levels more times than not. So anyway, as I was saying, this helps you with point number one, in that it helps you to only look for trade setups when the large degree picture is clear, and that will let you trade far less than you're probably normally used to, which actually is a good thing because you don't want to overtrade. You only want to trade when the picture is clear. So the second thing you want to try and do is when you're wrong, let's just place the analysis on this particular setup. So when you're wrong, you only lose a small amount. This is why we use position sizing. Here we vary the number of lots, contracts, or shares to keep our initial risk under 2%, in this case, a sample $20,000 account. Obviously, you have a smaller account, the risk could be too big. You have a bigger account, then you'll be trading more contracts. So the idea being is that you actually want to risk the number of contracts, lots, or shares to keep your initial risk at what we call one risk unit, which is for futures, 2% of a sample $20,000 account. If you're trading stocks, you want that significantly less, say 0.5 or maybe 0.1, 0.2 of your account, because obviously stocks you can't margin them as well as you can with futures. But the point being is that when you're wrong, you only risk one risk unit or 1R. That's the second point we want to try and do. So we want to lose small when we lose. Notice I said when we lose, not if we lose. There always will be losing trades. This is what professional trading is all about. It's about keeping the losses small. But today, I want to focus on trying to increase the profits. In other words, the last point. In other words, having the big R winners. Because you can see here was our first target on this automatic setup, where the profit was 2.2 or just over twice the initial risk. So what I want to try and get you to do, and I've touched on this a few times over the last month or so, the last few weeks, is that what you can do is rather than just looking to take your profits at the targets that are given by the software, what you can do is, particularly if the target is only a small target, it's only a couple of hours away from the entry, is you can then look to the higher time frame next resistance zone or support zone if you're going down for your target. So in this case, remember we put that resistance zone on the chart earlier? So in this case, what you can do is, rather than looking to come out here, where the profit was just over twice the initial risk, if you look to then go to the next higher time frame resistance, can you see what an effect it has? If you'd run your trade up to here, the profit would have gone from just over twice the initial risk up to 8.5 times the initial risk, or just over 8.5, 8.6R. Now, this has a significant effect on your bottom line. It's because when you're right, the profits are not only just large in dollars, but significantly large in risk reward units. And this is the point I think you all have to try and work on to try and let your profits run. Psychologically, this is quite hard because you're in a trade here. You're in a trade like there, you'd have got up to, say, 1R profit, 100% initial risk. You might, panic, I'll bring my stop to break even. You'd have been stopped out. Perhaps you got up to this level, you're sitting on about 2 or 3R. It started to retrace back a little bit. You may have panicked and say, okay, I'll bank that. 3R is a really good profit, 2R is a good profit. And that's it, you've been out. Or you might have got up to here. You're sitting on about 4R. You think, oh, that's not really good. It's just consolidating, going nowhere. Maybe I'll take that. And then you miss out. If you let it ride all the way up to there, you'd have had a profit of 8.5 times the initial risk. And just think about that for a moment. 8.5 times the initial risk means this one trade here could have paid for 8 losing trades. In other words, you could have still made 8 consecutive losing trades, and you could still then be slightly up. In other words, slightly in profit. So this is why you don't then, it makes trading easier, I think, in some respects, because you don't have to have a lot of winners. Trying to go for 60, 70, 80, 90% winners is extremely difficult in the markets, because all it takes is 1 or 2 big losers and you're wiped out. It's just so much easier if you have an 8R profit in the bank, then each time you make a losing trade, it only takes a -1R, excuse me, a -1R out of your account. It only chips away ever so slightly at your bigger profits. So in other words, your account is then moving up. So this is what I want to really focus on, or get you guys to focus on today, is trying to let your trades run. In other words, trying to get these big R profits. But of course, this takes time. The market, what was the time of that low? That low is at 12.21. The market didn't get up there till 3 o'clock. So what's that? 1.5 hours. Is that right? No, 2.5 hours. Half one, half two, half three. So 2.5 hours for that trade to unfold. So of course, all that time, you could then be panicking that you're going to lose out, and all the psychological games that markets play with your mind could be going on, and that then you could miss out on the big R profits. But it does take time. For a market to actually move, time has to unfold. In other words, it does take time to let the market make these bigger winners. It doesn't happen immediately. So that's why it's good to let these run. But psychologically, it is quite hard because you're in the market for quite a long time. But it's so important. It's so important to have these big winners. Timo said that he stayed with a previous setup and ignored a newly generated one because it was a bigger R winner. Was that good? Well, yes. If you made a good profit overall, that's a very good thing to do, Tim. Well done. Right, let's have a quick example of a Forex chart, then I'll come back to some other markets a bit later on, because I wanted to look at the Euro US dollar, because I had a question from one of our customers on using a 1 hour chart and a 15-minute chart on the Euro, particularly over the last day or so. So let's again do exactly the same as we do. I want to jump back in time here. As the market is moving down, like it's moving down here, we use the last swing in that same direction. So we'd use this pivot low for our DP. There's like 3 pivot lows here, all in the same area. So you could just sort of just double check and just see, what the DPs are doing in all these areas. And as you can see, they're pretty much coming into all about the same zone. So they didn't really matter. So let's take them off and let's have that last one on. So that's the support zone. It's on the chart there in advance. If we turn training mode off, what did the market do? Well, it came down into this area. This is the higher time frame, the 1 hourly chart. If we go down to the shorter time frame, here's the 15-minute chart. So can you see the market made a low at the higher time frame? Our MTP trend went from grey to blue. So after that, you should be looking at buy setups. So in this example, we'll be looking at some setups that unfolded after the low, not just at the low. So this was a good one to take. So if we take this one, that would have gone to the first target there and made a 2-hour profit, which would have been nice. It was at the target, but let's have a look what difference it would have made by going back out to the higher time frame and looking at where the higher time frame resistance would have been. As I said earlier, this is the last swing into the low, isn't it? That's the last swing to the low. So we take a pivot off or DP off that pivot. I keep missing with my mouse here. Sorry about this. And there you go. That would have been on the chart in advance. So if we go back to the 15-minute chart, let's see what that looks like on this 15-minute example here. So here would have been the target. So rather than coming out at 2R, if you'd run all the way up there, that would increase that 2R profit up to about 5R. So as you can see, that would have over doubled the profit. But of course, to get that, you'd have had to sit through this, all this wiggle and all this nonsense going on here. Even when you market, you almost got down to only half an hour profit before then starting to go back up again. Now, psychologically, this is really difficult to do. But can you see how overall it would have been a better result overall, because it would have increased your profit? Now, of course, the problem with this is that psychologically it's hard to do, not only because you have to let the market or give the market time to let it run in your direction, but also you then risk the opportunity that that sometimes the market will then come up to the first target like this and then roll over and then stop you out. And of course, then you go back and say, well, why on earth didn't I take profit at the first target when I resulted up in a losing trade? So again, it's the psychology of the markets that actually is the hardest thing that we do here. There's another interesting question here as well, is that what can you do when you get a setup that's in the same direction? I think, Timo, this is sort of your question as well, is that you're already long off this TS1 here. You then get another setup that's in the same direction that looks quite good, this one here. Interesting, look how its target was right at that higher time frame resistance. So that would be a good place to take profits as well. Of course, the market has gone beyond that. Now, in hindsight, you say, oh, how on earth could I have grabbed all this profit here? In reality, it's quite difficult to trade in hindsight because you don't know what it would have been at the time. So that's why we only ever want to look when we're trying to learn. We only want to ever look what happened at the time. So perhaps what I should do is I should go back to what the market would have looked like at the time. I don't know about you guys, but I don't like it when there's trading gurus and teachers. They always try and shift what they're teaching because they can see that the market has moved differently than what they actually teach week on week. I think that's cheating. I don't know about you. So here we are. Can you see how that would have actually given you a nice trade up to there for a nice 4.4-hour profit? But the question is if you were long here to start with, and you saw another setup in your original direction, in other words, long in this case, what can you do about it? If you're quite a new trader, particularly if you're new to MT Predictor, I'd suggest that if you're already in a trade and you're looking to run it further, don't then take another new trade. In other words, don't try and what's called pyramiding. In other words, adding to your existing positions, because that can then be quite hard for you to sort of manage both of them. But if you're more experienced and you did want to add positions, if you have more setups that are in the same direction as your existing trade, then what you can do is perhaps look to then take an additional trade here. But the one thing I suggest you do is that if you do this, at the very least, bring your stop to break even on your first trade. So if you're long off this one, bring your stop to break even on this first trade when you're in the second trade. In other words, it then gives you a risk-free trade off this first one. So if this second one is then stopped out, you'll then only then have the -1 hour loss on the first one, and you'll have no loss, i.e. break even on your initial one. Sorry, no loss on your second trade, sorry. And you'd only have break even on your first one. In other words, it'd be a risk-free trade. But of course, if it turns out well, you'd make 5R on that one, and then another 4R on that one. But pyramiding is something that I wouldn't suggest if you're not very experienced. I'd only suggest it, or even think you should even think about it or consider it if you're more experienced. In other words, if you've been using MT Predictor for a while or trading for a while, and you're quite happy doing that, well, then that's something you could consider. But the whole basic idea of this is just trying to let your trades run. In other words, trying to use the higher time frame support and resistance zones to try and let your trades run further, so it allows you to have higher time frame, higher profits. Does that make sense to everybody? And just out of interest, if you go back to that hourly chart, for those of you who have been who are eagle-eyed, you can see there was a history triangle down here. It was a history triangle because there was a double bottom. But would this have been a valid trade setup as well? Well, let's have a look. Let's go out to the 4-hourly chart. As the market is going down, you'd want to take a DP off the pivot in the same direction. So you'd want to be either taking a DP off that pivot or a DP off that pivot. As you can see, they basically fall in the same direction. So let's just take the first one off so it doesn't get confusing. So again, this is the higher time frame. This is the higher time frame chart. There's the last initial small swing into the low there, which is the DP we're working off. But also, as the market's starting to go up, there was the last sort of major last pivot high as well. So we could also then place that on the chart as well. It's a bit further up. So now if we go down to the hourly chart, let's see what happened as it came down to this low here. So I can right mouse click over that blue buy bar, place analysis on, and as you see, this would have given you a long trade setup. But it wouldn't have been stopped out, because when we do Forex to try and cope with the spread a little bit more, we tend to do a 2 pip offset on the entry and a 3 tick on the exit. So if I go to tools, accounts and risk, I then come down to risk profiles, I look at currency. Can you see here we offset the entry by 20 pips or 20 fractional pips, and offset the stop by 30 pips, so 30 fractional pips or 3 pips. So as it gives you a little bit more wiggle on the entry and the offset. We only tend to do that for currencies. By the way, if you did want to do that for futures, you can do that as well if you wish to. So in other words, this trade wouldn't have been stopped out. Now it went up to the first target where a 6.5 hour profit was available, but here's our next major resistance area. So you could perhaps try to look to run this a bit further. Now it hasn't got there yet. I don't know whether it's going to get there. No one does, because it's the future. But can you see how that would have increased, or would increase the profit from about 6R, which would be quite good anyway, up to a potential profit of just over double that at potentially 14R. So again, an example of where you can use the higher time frame DPs to try and look to let your trades go a little bit further. In other words, what I'm trying to get you to do is look at charts and not try and see the first place to get out that you can. It's almost like you're trying to run scared. In other words, oh, I'm in a trade, I'm panicking, it might go against me. I want to get out. I want to get out. In other words, you're looking for every opportunity you can to get out. So I want to try and move you away from that and almost looking for every opportunity to try and stay in. So you look at it and say, right, where's some further out targets? Where can I let that run a bit further? So what you could perhaps do here as well is perhaps go out to an even higher time frame here. And if you look at the daily, what it looks like it's doing here is it looks like it's making an ABC pattern here, doesn't it? So what you can do is if we look at the WPTs up, we can put where the wave C would be on here. If this was an ABC correction coming in here, and there's the minimum wave C zone here as well. So this is on yet a higher time frame on the daily. So it may well carry on up to get to at least the minimum wave C WPT there, if that's going to be at the very least just an ABC correction. So that ties in quite nicely. Can you see that? That minimum wave C ties in quite nicely with this DP zone here. So if we come back down to the 4-hourly chart, that would be that higher DP there as well. So it gives you yet another opportunity to try and look for reasons why you want to let the market run a bit further. And obviously you run the risk that it gets up to about here and then goes a little bit down again. But that's the risk with trading. So are there any questions on that so far? And does it make sense that what we're trying to do is that the 3 things we have to try and master to become a successful trader is, first, we need to trade less. We only need to trade when the picture's clear. In other words, we only wait for the ideal opportunities. That's point 1. Secondly, you want to have small losses. And perhaps a good example on that is I was looking at the British pound here on a daily chart. The daily chart, which one was I looking on the British pound? Oh, this is the one I was looking at. On the 4-hourly chart, as the market was going down there, here was the DP of the last swing to the low. So it came into there to make a low. And if you then came down to the hourly chart, or was it that? There was one I was looking at on the British pound that came into a good example of a losing trade. So that's what I was trying to look at. I was trying to say that point 2 is when you're wrong, you will then make losses. But the trick is trying to keep these losses small at -1R or one risk unit. And then the third point is then trying to run your trades. In other words, then trying to have not small profits of 2, maybe 3R. I mean, they're nice, but they're only small. But trying to look for reasons why you're going to increase these profits up to 11, 10, 15, 14R, 8R. You know, these are the kind of profits you want to try and get. So they are large R profits. They won't happen all the time because you have to let the market run or give it time to go in that direction. And of course, because markets are random half the time, you risk the markets then turning random and going in the opposite direction. So psychologically, it's quite hard to do. But over time, I think it's far better, because if you have profits that are large, then that makes taking the next few losing trades only -1R so much easier on your bank account. And if you put 14R profit in, you can have 2, 3, 4 -1R losing trades and still be up significantly overall. So if your bank balance is so much easier, but psychologically letting the markets run or giving the markets time to run, I think is the hard part. But does that make sense to everyone? And are there any questions on that so far? Yes, most people are coming in saying that it makes sense, and there aren't any questions on that, so that's really good. Right, let's have a quick look at where the E-minis are opening. Oh, it's like the markets are going up slightly from here on the market is just opened at 9:30 New York time. This is a 3-minute chart. Let's go to a 15-minute chart. That comes in. Yeah, it's just going up. And of course, this is the situation you can get sometimes, is we had the DPs working nicely off these highs and lows. Now it's just going up. So you're saying, well, where can I place any DPs off? Well, the simple answer is you can't, because there aren't any real, previous swing pivots to work off. So the market is just going up. So this is when you have to have the patience. It's like this, you just literally just have to let it go. In other words, you have to have the patience and discipline to only trade when you get a clear picture. And sometimes that doesn't only mean that you are sit out when the market's consolidating, going sideways. Sometimes it means that you sit out when it's moving strongly in one direction, because you can't get any support and resistance zones to then do your shorter term analysis off. So this does happen. In fact, let's have a look at let's go and have a look at the large degree picture on perhaps the ES here. Let's take everything off. Let's go out and do a daily chart here, just to see what we're doing here. Yes, this is very interesting, this is, because that was the low there, wasn't it, that came off this DP, wasn't it? So as the market was going down, there was the DP support that came in. Where's the next resistance area? Well, this is the last swing into the low, isn't it? There's the last swing into the low. So if we take a DP off that pivot high, that's the next resistance zone. So is it any surprise at all that the ES is rallying? Now, again, psychologically, this is really difficult to work with, because obviously we have all the chaos that's going on in Ukraine with Russia. So, of course, psychologically, we're going to think, well, surely the market's going to crash down when there's war going on. But, these are the levels we're working off with MT Predictor. And what's it doing? Well, it's rallying up. It's rallying up to the DP off the last swing into the low. If you guys have been with me for a while, this is the same thing I talk about week in, week out, month in, month out, year in, year out, decade in, decade out, about the swings we have on the charts and the pivots we work off them. So it's quite interesting to see this unfolding with the backdrop of war going on. So this would be an area where we want to have a look on the daily chart to see what happens if the market gets up into that level. On the NQ, again, let's do the same thing on that and see what's happening on that. Exactly the same kind of thing. It's going up. On the YM, exactly the same kind of thing. There's the support at the low. We haven't got anywhere near that DP yet. But on the NQ, so I want to go back to that. This wasn't quite so clear, was it? It didn't really reach that support zone there. That was the last swing to the low. That was only a little minor swing. It's gone beyond that DP. So this is again a case of where the picture on the NQ isn't quite so clear. But on the ES, we haven't reached the DP. On the YM, we've still got quite a significant way to go to the DP as well. So the minis are not singing from the same tune, the same song sheet at the moment. They're not singing the same tune, are they? They are quite different. But either way, it does look like the main thrust is on the upside at the moment and has been for the last couple of weeks. Yeah, Tim says optimism on peace talks. Well, maybe. Yeah. Maybe that's the fundamental reason of why it's doing what it's doing, my MT predictor analysis. Right, so that's all I wanted to talk about today. So are there any questions on what I've talked about so far? No, I think everyone's quite happy on that. So I think what we'll do now is we'll end the webinar there, and we'll look to see how the markets unfold over the next week. So I want to thank you all for coming into today's webinar, and hope you have a good trading week. But remember, only trade when the picture's clear, and then only look to take a -1 hour loss. In other words, keep your losses small and try to then look to run your trades a bit further to try and increase your profits. In other words, have your big R profits. So have a good trading week, everybody, and we'll be back to do it all again next week.